Hey, everybody. I was just looking at this slide right here that I was working on to make a presentation, and I thought, what the heck, I'm going to make an illustration that basically mirrors this annual savings of $10,000 a year for 30 years. Well, this one's coming in at an interest rate of 8%, so this person accumulates roughly $1.1 million over those 30 years and defers $66,000 in taxes, probably contributing to a 401k or some other pre-tax retirement account. You can see this is a tax deferred right here. So I said, what the heck? I'm going to see what these numbers would look like if I put them into a permanent life insurance policy instead and see if the value would be better if it was in the policy. And I'm thinking it would be. And that's because there's no market loss with cash value in a life insurance policy. You are not ever directly invested in the market. So I took this $10,000 and basically told the software I wanted to contribute $10,000. Well, in this case, I did $9,996 because I did monthly of $883. I left off the 33 cents, so there's $4 missing, but close enough. But what I also did on my illustration, my little tool here, is use a lower interest rate. So instead of the 8% that is used over here, I am going to use 5.99% instead, because I like to be conservative and I would rather under illustrate and over deliver instead of the other way around. I think, 6% I think is a fair interest rate, especially if you have a 20 or 30 year time horizon. So I do like to keep my interest rates low, as I said. And if I back up just a little bit, the historical rates for the S&P index, for example, are, well, these are 20 years of the S&P index right here. This is the S&P index. These are the four indexes that the life insurance company creates, their proprietary indexes, their version of the S&P 500. So 20 years of history, you can see that none of these are under 6%. So I feel like being at 5.99% is more than fair. And again, hoping that, over 20 years, we'd certainly do better than 5%. At least I would hope so. So I'm going to go back over to the beginning of the illustration because I was more surprised than I thought. Let's put it that way. I knew, I felt pretty confident that the policy was going to do better than if we had put money into a IRA, tax deferred IRA, not a Roth, but a tax deferred IRA. But I didn't realize much better it was going to do. So here is the valued client. I made this a female that's age 35 and she's a non-tobacco user, putting in $833 a month right here. And she's doing that for 30 years so that I can mirror what is being done over here. So she puts this in for 30 years for a total of $299,880, which really should say $300,000 if we were putting in an even 10,000 over 30 years, but close enough, you get the idea. So let's scroll down here and we're going to keep our eye on these columns on the right-hand side here, because these are using the 5.99% interest rate that I did. This one is using the fixed index that the insurance company offers at 4.75% right now. It varies annually. They set it every year and it's that way for an entire year. And then they reset it. So next year it could be higher, it could be a little bit lower, but it is the same for at least 1 year. But we're not using that account. We're using the S&P indexes. And this is a guaranteed 0.25%, which is extremely low, especially, assuming that we're going to get that rate for 30 years. I think the world would be close to ending if that was the case. So let's scroll down and see which did better. So over here, we've got the retirement account of, let's see, $1.1 million. And then this person wants to start taking withdrawals from their retirement account that they saved up for 30 years. So they are going to start taking roughly $72,000 a year out, which you see right here. Assuming they're in the 22% tax bracket, they would be paying just shy of $16,000 in income taxes on that money, because they did not pay income taxes on the money when they put it in. They got the tax savings every year over here, you can see. So now they have to pay taxes. And this is what we call paying taxes on the harvest instead of the seed. What does that mean? Well, as you can probably figure out, a harvest is much larger than the seed that started that harvest, right? So you pay taxes on the harvest or you pay taxes on the seed. That's how the IRS works. You have to pay taxes one way or another, at least if you're going to do things legally. So this example is paying taxes on the harvest, which means you're paying taxes after you've grown your account over 30 years, and now you're going to pay the taxes, okay, because you're going to take it out in retirement. And you didn't pay those taxes over the 30 years. You actually got tax deferred a little bit of savings every year to the tune of $66,000. And I think we can all agree that saving $66,000 in taxes here doesn't really offset the $398,000 in taxes you would pay when you take this money out in retirement. So it seems like you have a lot of money, but when you pay taxes, all of this money, unfortunately, is not yours to keep. So this big piece of the orange pie here is this $398,000 and change of taxes you're going to pay while you're taking out $72,000 and change a year for 25 years. Okay. And you're paying that tax because you decided to get a tax break when you put the money into your IRA. And you got a little bit of an income tax reduction. But again, because you're paying tax on the harvest, that harvest is much larger than when you planted the seed. Does that make sense? The seed being, you know, the $10,000 that you could have just paid the $2,200 in taxes instead of getting that reduced when you were contributing, but you decided to pay tax when you take it out, and now it has blossomed. You know, a seed grows, and hopefully, if you're a farmer, your harvest does well and gets bigger. So you're paying taxes now on a much larger amount that accumulated over 30 years than if you had just paid taxes individually for 30 years. I hope that makes sense. So with the life insurance policy, you don't have those issues, right? There's no income taxes due. Because you have put money into this policy after taxes, and the cash value of that policy grows over time. So let me just explain what all these columns are over here so you understand. The account value column is the column where your account is going to gain compound interest. Okay, so we put this little % sign here. So your compound interest accumulates on this column. This surrender value here is your cash value. That is the column that you can borrow money from. And this is your death benefit, of course. As you can see, the death benefit goes up every time you're paying your policy. Your account value is going up, your cash value is going up, and your death benefit is going up. And that will continue to do that until you stop paying premiums. And actually, even after you stop paying premiums, you will still be accumulating interest on this column here, your account value, and that interest will be added to your cash value, and it'll be added to your death benefit, even after you've stopped making your premium payments. And that's one of the flexibility points of an IUL, is that you can pay for 10 years, you can pay for 15, 20. As the client, you determine how long you want to make payments for, and is completely in your control. So, you know, figure out your budget, what you want to pay, and, you know, if you stumble on hard times, IUL is so flexible that you can actually lower that monthly payment. So instead of paying the $833 that you said you would pay, I don't know, maybe you lost your job, you got laid off for a little bit, and now you can't make those payments. You can actually reduce those payments to be significantly lower and still keep your policy open. I don't think you can do that with a whole life policy. I think they're not as flexible. So anyway, moving on, we're gonna go look at how much money can be taken out of this policy once the client has put in this roughly $300,000 right here. Okay, so $10,000 over 30 years, I'm rounding, is really 99.96, but roughly $300,000 over 30 years the client has contributed. And then we're gonna go take this money out through policy loans. So what's a policy loan? That is the ability for you to take this cash value out as a loan and do whatever you want with it. Right now, the rate for this particular company is 5%, and you can take this money out. And if you're a private money lender in real estate, for example, you take it out at 5%, you lend it out at 15%, you make a 10% spread. But the beauty is that even if you take a loan in this column, this is the column that continues to accumulate your compound interest as if you never took the loan out. Why is that? It's because this money that you're borrowing, taking a loan out of the policy, is not your money. It's the insurance company's money. So your money really stays in this account, and that's why it continues to compound interest as if you never took the loan out. So that's the beauty of being able to use the same dollar twice, right? The money stays in the account and compounds interest, even though you've taken it out and done something else with it. You know, maybe you're not a private money lender and you didn't make a 10% spread. Maybe you took that money out and decided to do a fix and flip. And you make that money, you sell the house, pay the loan back, and keep whatever the difference is as your profit, what have you. There's so many things you can do with the cash value in these policies, and using them to supplement your retirement is just one of those options. So let's go see what happens after 30 years. And this person wants to start taking loans at 68 because they're retired now. They put in $300,000. And look at this. They can take out $1.9 million tax-free in retirement. So $79,165 a year for 25 years till this person is 92 years old, okay? Starting at age 68, $79,165 a year until they're 92. Tax-free. You get to keep this, $79,165. You don't pay taxes on this. And before you think the loan's a bad thing, nobody knows about this loan except you and the insurance company. And that is because you're borrowing money from your life insurance policy. You're not going to the bank to apply for a loan. And nobody's going to run a credit check on you. It's not going to count against your debt to income ratio. Not going to hit your credit score. None of that, because nobody knows about it except you and the insurance company. Okay. So the insurance company will collateralize that loan with your death benefit. So what does that mean? Well, let's go and show you what it means. If you look here, when you start taking out loans in the policy at $79,165, this column, which is your cash value column, will be reduced by the amount that you're taking out of the policy, or the difference between the interest that the policy is gaining and the loan that you took out. So as you can see, the number was higher the year before at $862,497, took out the loan, but it didn't get lowered by $79,165, as you can see. Probably a difference of roughly, I don't know, $23,000 in here. And that's probably because of all the interest that is accumulating on $860,000. So this column goes down when you take out loans, and your death benefit is reduced as well. Because again, the insurance company is collateralizing your policy in the case that you die while you have these loans out. They want their money back. So these two columns will go down as you take out loans. But as I previously mentioned, this column, which is the column that compounds interest, does not go down. So even though you're taking out all this money to the tune of $1.9 million, you are still accumulating interest as if you never took those loans out, as you can see right here, because this column is not going down. It's still going up. Okay, so when I look at this and compare it to the IRA over here, I can take out 1.9 million tax-free if I average 5.99% a year for 30 years. This is assuming 8% for 30 years and 1.1 million This person has accumulated over 30 years. I have to back up one page. Let me show you that just so I can see what it is as well. So 30 years, this person has accumulated 759,661. Seems lower, and it is lower than the 1.1 million over here. But it doesn't matter. You know why? Because when you take the money out of this account over here, you're not still compounding interest as if you didn't take the money out. And you're paying taxes on it. So you're losing money in two places. Here, you're gaining money in two places. You're gaining money by having the full amount continue to compound interest as if you didn't take the loan out, and you're not paying any income taxes when you take this money out. Because again, it is a loan, it is not income, it doesn't show up on your tax return, no one's going to give you a 1099, a W-2, no one's going to give you any kind of tax form to file with your taxes. Because again, the loan is between you and the insurance company, and only you two know about it. So back to this page over here. Just again, showing that this amount here, when you're taking out these loans, does reduce your cash value column here and your death benefit. But this one does not go down, and this is where you're compounding interest. So we did 25 years of $79,000 and change. And as you can see, we are left with $42,000 of cash value. And this is why there's not another year that you can take out $79,165. But once you stop taking money out, you can see this number starts going up again, because all that interest on $3 million is still accruing. It's pretty crazy. It really, really is. I think everybody should know about how to do this, because this is one of many tools that the wealthy use that most of us regular folks don't know about. But now you do, and you should definitely look into it and see if you can put it to use, because this at $1.9 million to keep in my pocket, even though I only put in 300,000 and grew at 6%, 5.99%, blows the doors off of this 401k over here, because yes, you only had 1.1 million. So you had roughly, I don't know, $500,000. Maybe $400,000 more than what accumulated in the insurance policy, but we can take out a ton more because we don't have to pay income taxes, and we're still compounding interest as if we never took this money out. So this, in my opinion, is the clear one. I hope you guys think so too.